Hi, team. It's Accounting Fundamentals. And the question of the day is, what is a transaction? I'm sure you've been involved in a transaction before. Have you ever bought a coffee? Have you ever gone to a hardware store and bought a hammer or a bag of nails? Have you ever loaned a car from a friend and paid them $20 for them having let you borrow their car? What you're involved in each of those situations is a transaction. The difference between the first two transactions, buying a coffee, hammer, bag of nails, and the $20 you paid to a friend is, yeah, besides the friend making sure they got their money back, they really probably aren't going to make much of a record related to that transaction. Every time a business interacts with some other entity, that could be a customer, a guest, a supplier, a bank, that transaction needs to be recorded. Now, how we go through that recording process is, thank you, Luca Pacioli, we use something called creating a journal entry. And a journal entry is literally just a record, an accounting record of every transaction that is involved in the business. And yes, every transaction that's involved in the business. So any business is involved in making a lot of journal entries to record each of those transactions. And Luca Pacioli said, thank you, Luca, that every balance needs to happen at every moment within a business, and that in the double entry accounting process, the journaling process that involves recording a transaction needs to involve at least two of the different accounts within a business. In the journal entry process, we're going to use a column called debits and a column called credits. And that comes from the DC Adler process that we've been using in the class. So in every journal transaction, we're going to debit one part of the transaction under a certain account, and we're going to credit another part of that transaction under a different account. Now, we need to impact at least two different accounts in every journal entry. We could have two debit entries plus one credit entry to record one particular transaction. And if we did that, are we still meeting the criteria of having at least two accounts impacted? Yeah, we happen to have three, which is at least two. The other part of Luca's balance process is that in a situation where we had two debit accounts and we had one credited account, the dollar value of the debit side still needs to equal the dollar value of the credit side. If we had one debit account and one credit account, still the requirement is we need to have balance and harmony where the total dollar value of the debit account has to equal the total dollar value of the credit account. So let's look at some examples. So using Luca's lemonade truck as an example. So Luca, I'm going to switch the share view here for a second. When Luca is looking at, and when Luca's transactions are occurring. So here is an example. We've got December 1, $10,000 cash loan from the bank. That's a transaction. December 2, but Luca buys a truck for $5,000 cash. December 3, Luca pays rent for $300 in cash. December 8, Luca sells product and receives $800 cash for selling the product. December 10, Luca goes to an ATM machine and withdraws $100 in cash. Separate set of transactions. January 5, $25,000 cash loan from the bank. On January 7, Luca bought an ice cream machine for $3,000 cash. On January 9, Luca paid rent for $400. On January 11, Luca sold product for $900 in cash. Come down to another set of transactions. On February 2, Luca paid $3,000 to a marketing company. February 8, Luca bought a laptop computer for $1,200 in cash. What you'll notice and highlighted here is cash, cash, cash. cash, cash, cash. Where cash is involved, cash is either coming into the business or cash is going out of the business. In other transactions, here's one where February 25, Luca bought food items on credit for $900. It doesn't mention cash. So what was going on in this situation is that Luca bought $900 of food from a vendor, from a supplier. They delivered the food and they said, hey, Luca, pay us in a month's time. We're going to give you 30 days credit to pay that $900. So in this situation, supplies came in, but there was no cash going on. So the point is, sometimes there's cash involved in a transaction and sometimes cash is not involved in a transaction. So when we record these transactions, we're going to use the journal entry recording process. When we record these transactions, we're going to have a column that's titled debits and a column that's titled credits. We need to have balance so that the total of the debits need to match the total of the credits in that journal entry that reflects that in each individual business transaction. So when cash is involved, either cash coming into the business or cash going out of the business, we record that journal entry in a certain way. In a situation where cash is not involved in that transaction, like the example of Luca received supplies on credit, supplies came in, but there was no cash involved, then it's just a different extra step that's involved in recording that transaction in the journal process. So we're going to look in the journal entry process. We're going to look at each transaction and go, is cash involved or not? If cash is involved, is cash coming in or is cash going out? And we record that journal entry following some simple steps in a certain way. If cash is not involved in the process, then DC Adler to the rescue. We're going to use our DC Adler structure to help us figure whether it's a DC Adler normal balance or whether it's DC Adler situation in the mirror image process. If it's DC Adler in the normal balance process, then the dollar value of that account is increasing in that transaction. If it's DC Adler mirror image process, then the dollar value in that account is decreasing in that process. Now, I use the terms normal balance and the mirror image process, assuming that you've watched the video on normal balance. And if you haven't, you need to get after that video to help you understand what's going on. Because the normal balance and the mirror image is going to be a component of recording journal entries where cash is not involved. So this is all about transactions. What is a transaction? We get it. It's an interaction between a business and any other entity in the commercial space that the business interacts with. How do we record that transactions? We use what's called a journal entry. What's a journal entry comprised of? It's comprised of using a debit column and a credit column. In the transaction, we look for cash. Is cash involved? Yes or no? If it's a yes, was the cash coming in? Was the cash going out? If cash was not involved, then we just use our DC Adler normal balance or the DC Adler mirror image structure to help us figure out how we decipher and record that transaction as part of the journal entry process. Okay, ready to give it a go? The next step for us is going to be actually recording journal entries and the transactions that are reflected in those journal entries. It's going to make sense. Even if right now it seems a little murky, it will make sense when we get going. Ready to try it? Here we go. Come soon.